Hi, all the joinees on this call. Thanks for coming online. I'm Parikshit Kandpal. I track real estate at HDFC Securities. I've been tracking this sector for last 13 years now, so have seen a lot of cycles and how the sector has behaved over different crises. So, so just to give you a background, the real estate has been picking up in early, if you say 2002 2003 onwards, there has been pickup until 2007. We have seen a very sharp run up in the prices, and after that the great financial crisis hit us. So there has been an opportunity there where people got an opportunity to buy their apartments at good price corrections. But after that the new government came in, and we have seen the sector again recovering until the demonetization came, and then it was a big blow for the sector as a whole. And then followed that as the demonetization was fading, we saw the LFS crisis, and then we saw this GST thing coming in, RERA coming in, and then we have now the DHFL crisis, which almost sucked the entire liquidity for the sector. The large part of funding of the real estate developers was coming from NBFCs for the land buying, and some of the riskier projects also getting funding from these NBFCs. Now with the NBFCs totally out of this game, the COVID hit this sector. So the challenges remain for the sector. So I'll first cover three segments of this. One is the residential real estate, then I'll go to commercial real estate, and then I'll cover the retail real estate. So looking at the residential real estate right now, you may be reading a lot of media stories around the high levels of unsold inventory, and the selling as the pre-sales has been very low. There has really hardly been any offtake, and at this time the COVID came in. So what is happening now is that if I see the overall sector right now, the investors or the buyers are looking at discounts of 15 to 20% in the current times post the COVID. There is good interest. Along with that, the Maharashtra government has come and they've cut the stamp duty and registration charges, so which is now at almost 2%. So there is a 3% reduction there. So what it does is that this 3% cut for a limited period of time till December, and then another 2%, it increases, so the cut reduces to 2% by March. So what it does is it brings a lot of fence sitters who have been looking as an opportunity to buy into real estate to come in on the negotiating table. So if along with this 3% reduction, if the developer is offering 15 to 20% discount, so the deals are being done. So when I was interacting with a lot of this brokers, and I was doing primary channel checks on the volumes and demand for the real estate in Mumbai and other places. So the trend which we are seeing is that the demand thing, the inquiries have gone up sharply over last 7, 8, 10 days. People are looking to cash in this discount which has been given by the government, along with the offers which the developers are giving. So even the resale market has suddenly become more vibrant. A lot of investors who have been holding the inventory but were not able to sell over last 4, 5 years, and these projects are nearing completion. So they are seeing this window as an opportunity to liquidate their stock. So some of the investors are holding as high as 10 flats, 20 flats, 15 flats. I mean, so the numbers are like in double digits, the HNIs. So we are seeing some of the resale market, the deals are happening. I know at least 4, 5 deals which I personally, some of the known people are buying. So there has been a discount almost 20% being negotiated in the resale market. Okay, so if I go into the residential segmentation now, there are two type of inventory in the market. One is the ready completed inventory, and what is the under construction inventory. So ready completed inventory, the buyers are looking at all the projects. They are builder agnostic. So they are not saying that, okay, if a builder is not doing well, I'll not buy because the product is ready. So they are just waiting for a good discount. They all know what is their budget in their mind, and they are sitting across the table. And we have seen a very sharp recovery, a very good pre-sales happening in the completed inventory. Now coming to under construction projects, so I would say there is a clear segmentation. People, the buyers want to be, they want to remain with the bidder developers who have got strong balance sheet. They believe that if they can deliver over next 4, 5 years on the committed timeline, so they are only going and tying up or buying their projects or their flats from these developers. So clearly some of the tier 2 developers, where there are concerns, where there are news flows that these developers are not able to basically arrange funding and they may not be able to deliver, so people don't want to park their monies and buying flats with them. So the trend is shifting towards more organized players who have got strong financial backing, got strong equity backing, either from like investors like mutual funds who invest in their secondary offerings like QIP. So those kind of developers are getting more stronger, and the demand will consolidate within them, within the ambit of these 4, 5, 6 developers. So clearly, this year we are seeing the residential demand will reduce by 20-25%. But what it does is that the overall supply which is coming in will be restricted only to handful of developers. So maybe if Mumbai has 15 to 20 developers, large developers, so we will see only like 5 to 6 developers gaining market share, despite the overall residential demand contracting this financial year. So clearly there is a movement towards consolidation, and larger players stands to benefit from this COVID-19 pandemic in terms of doing better pre-sales. So I would assume that this quarter, so first quarter we had seen the residential volumes have been around 40-45% of the pre-COVID levels. This quarter we are expecting it will go back to 65-70%, and by third quarter, which is the festive season, along with the discounts and the offers and probably some new launches by some of the very reputed developers, there could be a normalcy coming in towards the end of the third quarter. So by October, November, December, somewhere in that period, we are seeing the volumes will come back to normalcy, obviously supported by a reduction in the property prices or the offers given by these developers. Okay, so we, in terms of pricing trend, as I said, Mumbai, if you're looking to buy apartment, you should negotiate hard. You should sit across the table. You can get a good deal at 15-20% discount. If you are looking to buy something in southern India, or maybe a Pune, or maybe NCR, so depending on the ticket size, these markets are still more affordable. So here discounts won't be more than 10%. Because already these are all like more affordable segments in terms of the ticket sizing. So that was about the residential real estate. So we remain positive on more larger organized players because they stands to benefit. A lot of corporates are also coming into this real estate because some of the players we are seeing the more aggression coming is from Mahindra Life Spaces. So Godrej is already there. Oberoi is one of the large ones which is already listed. So Bharti Realty, I would assume that even in the near future, maybe a couple of years down the line, Reliance will also come into real estate. We have Century, which is already into real estate. So everyone is trying, even L&T in a big way. So it being itself an engineering construction company, and a lot of residential projects are developed by L&T on the construction side. So now L&T is also maturing, and it is getting into real estate development by taking up distressed assets. Even the Swami Fund, which is the government's fund for revival of the real estate residential projects, has already committed 10,000 crores worth of funds to the projects which are stuck up. So this will also bring an incremental supply to the market. So we are seeing that prices are not going anywhere from here. We don't see near-term appreciation in the prices. That there's a downtrend which may happen, downtrading may happen because to prop up volumes, and this should be beneficial for the sector as a whole because the liquidity, the developers will start getting liquidity as they monetize their unsold inventory. So that is about the residential real estate. Now coming to the commercial real estate. So commercial real estate has its own challenges as of now. The larger listed REITs like Embassy REITs and Mindspace REITs and other office players like DLF, Brigade, Prestige. So they have been able to collect rentals from most of the large IT tenants, the financial MNCs, which have taken up spaces in their SEZs and offices. So collection efficiency has been as high as 95%, closer to almost like 95 to 100%. So when we interacted with most of these occupiers, so the sense is that clearly, as of now, most of the large MNC occupiers are looking at business continuity plans. So they want to disrupt anything as of now, though they have asked for negotiations and reduction in rentals. But these contractually, the landlord is not bound to give them any discounts because this is not a force majeure event. Contractually they are not giving any discounts to these MNCs, but these MNCs right now are staying, they are focusing on safety of their employees, they are focusing on business continuity. So I don't think that immediately there could be corrections in rentals, at least for next few quarters, until a vaccine comes in and there is some concrete decision taken on the work from home. So work from home remains the biggest risk for this office space, but as of now there is a very limited visibility that how much of the corporates will actually move their workforce to work from home. So that's the evolving situation. So we remain mildly positive on the office space as of now, because we believe that the rentals as overall cost for these corporates is almost 3 to 4%, and with the this now people working from home, there could be a directionally there could be more offshoring which can happen to India, because these corporates will try to cut their cost first on site, and they'll try to do more offshoring to the Indian IT companies or their own captive MNCs companies, so which may in the midterm again lead to the increase in demand for office. In the near term, because of social distancing, I would say the developers, though if they even if they continue to operate at higher work from home levels, but because of social distancing, the overall area which is required, so that should suffice with the limited workforce which will be working in these offices as of now. Now coming to so that was about the office. So we remain mildly positive on this sector. So we believe that work from home may not be structurally a very big change driver, as the developers will again recalibrate the supply coming into the market, so to adjust to the new reality. The third thing will be about the retail malls. So in the retail mall segment, we have the largest listed player, which is Phoenix Mills. Some of the other developers which have large retail mall exposure is DLF. It has almost 550 to 600 crores of annual rentals coming from malls. Phoenix has almost 1,000 crores of rentals coming from the malls. Then we have Prestige, which has 350 crores of rentals coming from the malls. Then we have Brigade. So these are 4 or 5 large listed players who have the malls exposure. So right now the malls are suffering because of the COVID-related shutdown, which had resulted in some of these malls being closed for a longer period of time. Now across India, most of the malls have already opened, but the consumption of the footfalls are almost 25 to 30% of the pre-COVID levels. So first, there is a restriction on multiplexes and food and beverages shops to basically open out of these malls. Even in F&B, they are only allowed to give takeaways, so no one can go and dine. But I think gradually people they'll allow that, but still people, the buyers, the consumers are scared that we may contract COVID if we go there. So earlier malls were more of an entertainment center, more of a socially kind of get together kind of a center where a family of like a husband, wife, and 2 kids and the parents used to go and maybe watch a movie, or they can dine together, they can do some shopping. But because of the scare, the COVID scare, only the people are visiting there for essentials. Even on the weekends when there is really a big footfall, it used to be like weekends were loaded on the footfall side, because of social distancing norms being followed by these malls, because they've been advised by government to follow strict social distancing norms. So people are thinking that, okay, if I go there, I'll have to stand in a queue. So that is also preventing people to visit malls. So I think that this will continue to impact the mentality. So everyone's mind will think about why to visit a mall now. But once the vaccine is out, which we believe the early next year should be out, and when people get vaccinated, so by next Diwali, so my interactions with a lot of unlisted players in the mall space like Blackstone and Xander, so their sense is that by next Diwali we should be normalizing in terms of consumption on a monthly basis from these malls once the vaccine is out and people start visiting the malls again, when the scare goes away. So I would say, at least in case of malls, we know that the worst is already in the price of some of these stocks, especially in case of Phoenix. We know that, okay, the worst is already in the price. And if you go and listen to Phoenix calls, earnings calls, and the commentary of the management, so they are saying on a quarter-on-quarter basis, they will continue to start building in consumption and improvement in the financials from here on. So we know that what is the worst there, and things can only improve from here on as the unlock happens and people start visiting the mall. So I would say that in the next 1 year, we could see a sharp re-rating in the Phoenix Mall stocks, because it's only pure play listed retail mall player. So that is about the retail. Also on the consumption side, I would say the consumption is not going anywhere. So right now people are not visiting mall, but high street retail consumption, so these all shops which are there in other market, non retail shops, so there the demand is already reversing to the pre-COVID levels gradually. So there has been sharp uptick in the demand there. So we believe that consumption is definitely going to come back once the vaccine is there. So I would say most of the people who are at work from home right now, so there has been some savings, so they have been net savers, at least the guys who are lucky enough and still have their jobs, so they have been able to save, and they are looking to invest in personal lifestyle. So the overall consumption pie of the household, so people are, whatever savings, that part of that also will go into the consumption bucket of these consumer goods. So people definitely want to invest in their personal lifestyle, and that should benefit this mall. Another thing is that these malls are all in urban areas right now. If you see in India, there are only about 100 malls, large malls, and out of this, 60 to 65 will be grade A malls, and which is roughly around 30 million square feet of total overall grade A mall stock in India. But when we go to US, the largest listed retail REIT there, Simon's property, so it has almost 8 times of India's grade A stock. So they have, like, if we have 30, so they have almost like 6 times, 6 to 7 times, almost 170, 180 million square feet of leasable area. So India as a market is very small right now, and there is opportunity to grow as the younger population goes into employment and starts earning. So there is a big propensity for them to consume. And this urban trend is now also moving towards the tier 2 cities. So the player like Phoenix, what it can do is that it has already a model in place. They have already proven in their malls in Chennai, in the malls in Pune, in the malls in Mumbai. They have already got a set of tenants, so they can easily replicate this story in any other tier 2 cities. So now they've expanded into Lucknow. They are into getting into Ahmedabad. They are going to open a mall in Indore. So in Pune, they are opening another mall in Wakad. So in Bangalore, they're opening another mall which is in Hebbal. So these 5, 6 properties which are coming up, that should add incrementally to the overall revenues. We expect the rental revenues to double from 1,000 crores now to almost 2,000 crores in next 4, 5 years when all these properties become operational. Okay, so and for them, funding is not a constraint. So recently, they have done the QIP. They've raised 1,100 crores from, and the demand was almost 7, 8 times. They have raised it at 603 rupees. It was followed up by a promoter offer for sale of almost 830 odd crores, which was, again, there was a huge demand. So funding is not a constraint on the equity side for them, because being the largest Indian mall operator with a proven track record, execution track record of delivering malls on time, getting the occupancies to almost 95% plus, getting best of the talent, best of the tenants, MNCs, larger brands, luxury brands, so that the consumption goes up, their rentals increases. So they've been able to deliver on all the fronts, right from delivering the property on time, getting it leased on time, getting the occupancies to the highest levels, and month on month and quarter on quarter, actively managing their entire tenant portfolio. If some store is not performing, they'll replace it with a new store, so that they can continue to deliver growth on a yearly basis. So now this model they'll replicate in some of the other malls which they're opening, as I said, and being a proven business model track record, the company will definitely gain from here on. So the overall theme is that residential is looking to pick up. I would say third quarter will be a good quarter. From there on, I think the bottom is already, the worst is in the first quarter is already behind us. Second quarter will also be an improvement, and third and fourth will continue to build on. Pricing, I would say there is a correction which can happen. If someone is looking to close the deal, you can negotiate, and developers are ready to part with discounts. The moratorium is already over. Real estate was worst impacted because of COVID. Now, with the moratorium ending on 31st August, these guys have to get the liquidity back. Otherwise, there'll be challenges. There could be issues with regards to bankruptcies, NCLT. So they don't want to take that risk. So they want to raise liquidity and cash flows. In this environment, even banks are not supporting. Banks are only looking to support those developers with a strong balance sheet. So as I said, the theme will be on consolidation. So if someone is looking to invest in this sector on the equity side, they should look at the top players within the macro market. So say in Western India, we have Godrej and Oberoi. So these stocks, the very strong balance sheet, proven track record of delivering project, best of the brands in these markets. So I think if they give a decent discount there, they should be able to do very good sales. So similarly, in southern markets, we have Shobha, we have Brigade, we have Prestige. So these are the top three market leaders there, and the demand will again consolidate within themselves. If we go to northern India, we will see DLF, the largest player, largest Indian listed real estate company. So again, there DLF will continue to do well. They have already deleveraged their balance sheet to a large extent. They've got a large investor on their office portfolio, which is GIC. So there could be, and they are building out their rental portfolio. Even in this time, they are doing capex, and I think in next they are in initial plans of doing a REIT, which may happen in next 2-3 years. So even DLF looks attractive at these levels. So if I have to put the topic wise, I would say one should look at the mixed use kind of a developer. So my topics in this segment would remain DLF, Oberoi, and Phoenix. So residential, DLF, residential mixed use and office, so DLF. So then in the market segment, the market leader in NCR, then I would go in Western India, I would go with Oberoi. And then on the retail side, Phoenix. So these will be my 3 picks. In the southern market, I will maybe look at Brigade and then Prestige. So this will be the topics which one can look at adding if there is a correction from here on, start accumulating at the lower levels also. And we are looking at the re-rating to happen over next 1 year. So these stocks can give you decent returns going ahead. Yeah, so now we can move to question and answer, Shyam.
Thank you, Parishit, for a nice introduction on the real estate current situation that we are facing right now. We have lots of questions from our viewers. We'll just take one by one, and probably can elaborate more on them.
Sure.
The first one we have is the real estate sector has seen a great time few years back. Even then, it was very highly priced, and there was a lot of surplus. Now the activities has picked up, but there are a lot of unsold properties across the developers. We still have large inventory, plus there are a lot of planned structures in the pipeline. How do you see the sector recovering and reach an equilibrium in this scenario?
Yeah, so the thing is, so there is demand is always there for real estate. So real estate is the only sector where people do plan for their next generation as well. So as the population expands, so the families nuclearize and the demand keeps going up. The only thing is affordability is there or not. So right now, I mean, everyone, I would say most of the people would look at, especially the family pressure to basically either move or upgrade from a smaller house to a bigger house, little more outer location to a more central location. So there are different factors which drive the real estate upgradation or buying of new properties, or maybe a couple getting married. So now the family wants to have their own house. So the COVID thing is, what it does is that it has accelerated the owning of their house. Okay, so the only thing which requires is that, first of all, if a person has a sustainable income, if he has sufficient visibility that okay, he is not seeing any threat because of the COVID thing, and he's comfortable on his cash flow situation. So now the only thing he has to do is that, I would say, this is the best of the times to go on the table and negotiate with the developer. So there's no harm in visiting a developer's office, go negotiate, give your offer and come back. So I would say there's a very highly likely chance during this crisis time, because even developers want to exit from their inventory which they have built up, and they know that this is the window which the government has given them in terms of reduction of stamp duty. So that will add on to their overall value proposition to the client. So I would say inventory will always be there, because some of that inventory was never meant to be come to this market. So definitely now, just 1 second. So, but if you see the quality inventory, I would hardly say if you're looking to buy a house and if you choose down to your options, so you will hardly see that out of like 100 flats which you may see, so you look at only 10-15 flats will be like what you will look at like buying out. So I don't think that you will like all the flats. So be specific where you want to buy, what you have in your mind and your budget, and make an offer to a developer. I would say there's a highly reasonable chance of you able to get your deal. So don't hesitate. Don't look at what has happened in the history. But right now, the buyers have an upper edge. It's a buyer's market right now. It's not a developer's market. So clearly, I would say in ready inventory, look at even the resale market. there are good deals available in the resale market. I am myself seeing 5-6 deals happening at 20% discount, which has been closed very fast in last 7-8 days. So please, if someone is looking at buying, go ahead and choose your project, choose your location, and give your budget and negotiate with the developer. And I'm reasonably confident that you will get a good deal.
So the next question is about shopping malls. The person is asking if in the case of shopping malls, if the rental reduces, the shops may be able to survive, but the mall owners are facing a margin contraction. While if the rentals are increased, the shop may find it difficult and bear the cost and plan to move out of the malls. Still, the mall owners suffer. How do you see this panning out in the future? What would be the scenario in the future?
So if you see the construct, a mall construct, so I would say the clients of these malls are typically very deep-pocketed guys. So guys like Shoppers Stop, Titan, you have Trent. So all these are like Adidas, Nike. So a lot of MNCs. You have jewelry shops. You have Starbucks. So all these are like high-end brand, aspirational brands, and they give you an experiential retail kind of a format once you visit a mall. So these 15 occupiers, large 15 occupiers would almost have a bargaining power to the extent of 75 to 80% of the mall's leasable area. So landlords know this reality. So what they have done is during this pandemic time, they have come to an arrangement. They have said that we have to coexist. So we will take a hit. Government is giving us moratorium. So we will give you reduction. So they have given almost 50 to 75% rental discount for the COVID period until their occupancies or the consumption comes back to 70 to 80% of the pre-COVID level. And once they are back at 70 to 80%, the rentals will come back to the normal levels, and these tenants will give them some extra revenue share for the period the mall was, they had got the discount. So if they got discount for 7 months, they will give some extra share to the owners for under 7 months. So it's a win-win for both of them. So they have to coexist together. So I would say some of the ones like immediately the guys who will suffer are the guys who are more unorganized. Some of the players like F&B players who are not having a very big chain, they were there, so they will suffer. The multiplexes are more organized, and some of them like PVR, Inox, so they are deep pocketed. I think PVR has already done a rights issue, so they will continue to survive. They're not paying any rent right now. I would say that after the malls open, after the vaccine comes in, they will see the demand coming back. And then maybe they will find a formula. So the settlement of the rentals still not happened with the PVR, the multiplexes and the F&Bs, so and the entertainment areas. So I think the developers and the owners will work out some solution. They want to coexist and continue to have their presence in these malls. So I don't think they have any better avenues rather than to be present in malls, which attract so much of footfall and consumption for them. So I would assume that it's just about a year's time when things will start turning towards normalcy.
Okay. The next question we have is, since you have covered a lot about Phoenix Mills, the person is asking the valuation looks too stretched, and the ROCE is about 20% plus. Now with more inventory coming in with acquisition and new projects in the pipeline, the return ratio would naturally remain low. So what do you think is the lag time when the actual money is likely to start to come? Will the valuation be able to justify the current numbers?
So see so Indian real estate is, if you see the construct of the shareholding of the Indian real estate companies. So as I said, there is a big consolidation which is happening. So demand side, these guys will gain market share. Second thing is that they are deep pocketed. The guys like Phoenix, they have recently done a fundraise. So I would assume that there won't be any liquidity challenges for them in the near term. And if at all the unorganized sector or the weaker developers are facing any issues in terms of liquidity, their assets will be put on sale, and these guys will have an opportunity to buy out the distressed assets. The shareholding construct, if you see the large part of the shareholding of most of the real estate companies is from FPI money. FPI money has a very low cost, and they chase quality promoters, the market share leaders in the respective businesses. And the current corrections, the Phoenix was available at 950 odd rupees pre-COVID. Now it is at 630, 40 rupees, 650 rupees. So there has been a correction. Their malls are new malls will start getting added. With the lower debt now because of the fundraise. So I would say, as I earlier said, that the consumption has not gone anywhere. So as the recovery happens quarter on quarter, we will see the stock re-rating higher. The FPI money at low cost will, even if we say that fundamentally the things are not looking great in the near term, but FPI take a longer call. So they will do the flows will basically lead to the cap rate compression. So once the cap rate compression happens, the prices have to go up. That's the only way the cap rate compression can happen. So being a market dominant player, market leader, and the investors having faith, and there is a scarcity premium with a similar kind of a pure play listed entity, the liquidity will, I would say, lead to cap rate compression and re-rating of the stock, and fundamentals will obviously take 2 to 3 quarters to catch in, but I think market will price in before that happens. So every quarter we may see some re-rating on the stock towards the Diwali, where I would say Diwali should be significantly get re-rated from here on.
So in your report that you have shared, you have said a buy rating on all the covered stocks. Which of those expected to do really well, and what timeline should one should expect?
So as I said, my top picks within the sector is like go with the so I don't want like you if in Bangalore there are 3 players, Brigade, Shova, and Prestige. So I would say maybe you can look at adding Brigade. So one of the players you can choose. Look at diversification. So don't have a concentrated bet on all the 3 players in that market. Either you can split one third, or you can look at buying any of these ones. So Brigade would be my preference in that market. Second would be DLF in the NCR market, and Oberoi in the Mumbai market, and Phoenix Mill on the retail side. So these 4 stocks will give you a diversification across the Indian geographies.
Anybody from the Bangalore on the southern side?
Yeah, I said Brigade Enterprises is one can look at. And yeah, so that is what I've covered in this report. Yeah, all these coverage stocks I'm covering.
We have one last question for today. It's about the REIT IPO. We recently saw an REIT IPO, and they mentioned that a lot of lease is up for renewal. If they renew at current low prices, it will have a lasting impact on the P&L, because these contracts are usually 10 to 15 years long. Also, large corporate will not compromise on their side of the bargain. How would companies deal with such a scenario?
Yeah, so as I earlier touched upon the office space, there are multiple headwinds which are currently playing out there. So and these are all unknown. So tailwinds are like if someone can work from home, then there's no need for a person to be in onshore. So there could be offshoring, higher increased offshoring. So that is one tailwind which the office space currently has. And there's a politics also happening there because there's an election in US. So after the election, what happens and what is the rhetoric Trump plays and other players play. So the politics is one side of it, but the trend clearly is towards the trend is more towards offshoring. Now, if things can be done from home, then why not in India? Why do someone requires to have on-site presence for doing it? So that is one logical conclusion. Other thing is that if the offshoring increases, then what happens if someone is, why do one needs to go to office? He can even work from home. So these residences can become your own offices, but then again the client should accept that whether the client sees any benefit. There are data breaches, there's a concern on like connectivity issues. The connectivity infrastructure is not there in some of the tier 2 cities, so then people will again have to stay in urban areas, and then it makes sense for them to again go back to office rather than working out in a small house in Mumbai. The people want to socially interact and do ideation in their office. So there are pros and cons for both the things, but it's a developing situation. So as I said, I'm mildly positive on the sector right now because it will take at least 3 to 4 quarters to get more clarity here, because the commentary right now is of at least some portion of work from home being retained. But once the vaccine is out, I don't know how the behavior of the companies will change and how the client behavior will change, if the client will allow that or not. Some of the financial companies definitely will find it difficult to do work from home because of the data integrity issues of the customers. So that's why I said when I said you're looking to office exposure, look at a player like Brigade, which has a higher clientele from the financial services rather than IT sector. They have clients like Amazon, they have clients like Mercedes, So they will have 600 to 700 crores of rentals in next to 1 year time frame, 1 to 2 years. So someone can look at Brigade for that matter. So REITs definitely, I would say the performance in the near term may get clouded because of the issues around the work from home. If the tailwinds on the offshoring side is much higher and gives them a larger volume, then I would think the concerns will go away. And if the corporates decide to work from home may not be that significant part of their overall workforce, that should also be proved to be a tailwind, and then there could be the clouds will get removed and then the stocks will get re-rated. But purely from the income levels, I would say, yeah, someone can, at least for next 1 year, you can still hold them. And as the situation develops, you can take a call. You will get to know that from the media or from other research or from ourselves, our side also, when we do the channel checks on what's happening there. And then you can take a more informed call. But as of now, I would say you're just mildly positive to neutralish on that segment.
Any opinion on RET as an investment option?
See, REITs can say if it was pre-COVID, I would say it's a very good option if someone is looking to have a portfolio wherein you have a growth stock and you have an income kind of portfolio. So large part of your allocation, if it is into FDs and you are getting a sub 4% kind of returns, and that doesn't make sense. And because it's also not tax efficient, you also pay a tax on that. But REITs, what they give is that REIT is like a Mindspace. It's structured to, in a sense that the dividend is almost, large part of that dividend or distribution will be dividend, and it will be tax free in the hands of the investors because of they have not opted for the lower corporate rate. So they'll continue to be on MAT or higher corporate tax rate. So that's why the dividend will not get taxed in the hands of investors, and large part of the distribution will be dividend. Similarly, Embassy is also planning to do that. So InvITs and REITs both, IndiGrid, Embassy, and Mindspace, and IRB InvIT. So these are the four large listed public REITs. Then you have some of the private REITs which are listed, like Indian InfraREIT is there, but then you cannot buy because it's largely institutional. It doesn't get traded. It's listed, but there won't be any volume because these guys are not selling. So someone who's looking at right now, you can get 7.5% kind of a NDCF yield, and the distributable cash flow yield, plus if the rentals increase every year and plus the market opportunity, so you can get another 5 to 6% kind of appreciation. So you can get 13 to 14% kind of return CAGR, and large part of it would be tax free. At least the dividend part will be tax free. The capital gains, obviously, you'll have to pay short or long term, but I would say the large part of the half of it almost will be tax free. So it's a good avenue for an alternate, a reasonably optimal risk return kind of a profile, slightly riskier. It's a hybrid kind of a product between the debt and equity. So someone has an appetite, he can and wants to pick up a higher yield with a high A grade asset, so he can invest in these platforms and maybe make a yearly 7% kind of a dividend inflow and another 5 to 6% kind of appreciation. So you can get on a longer term basis, a sustainable long term basis, you can have a 12 to 13% kind of a return CAGR on your portfolio, irrespective of how the other equity markets behave, because these are largely long-term contracts, 9 to 10 years kind of contracts. So they are largely insulated from the cycles, up and down cycles. So they will not give you phenomenal return on the upside also, and they will not also protect to a large extent the downside as well. So more of an income product one can look at adding in their portfolio allocation.
Thank you, Parishit, for the information that you have provided on the real estate. It was a wonderful session, but due to paucity of time, we can't take any more questions. Thank you, viewers, for listening to us, and see you next time. Thanks, Parishit.
Thanks for attending, guys, and listening to us. It was really nice to interact with all of you, and happy to answer any questions which may come up later, maybe next webinar.
Thank you all.